Well, if you have any clients that are condominium corporations, or if you have any clients that live in condominiums, you might want to just mention to them this new technical interpretation from Lisa Zenas. And she notes that a condominium corporation is exempt from tax, but only if it meets the requirements in paragraph 149(1)L. So it may or may not be exempt from tax. It's exempt if it's organized and operated exclusively for social welfare, civic improvement, pleasure, recreation, or any other purpose except profits, a club, society, or association, and then its income is not available for the personal benefit of a member or shareholder unless the member or shareholder is an association which has its primary purposes as amateur athletics. Big deal. Anyway, if a corporation does not meet those requirements, then it is subject to tax on its taxable income. But in this case, when it is subject to tax, generally a portion of the fees received by the condominium corporation from all of the owners will be used to pay for the year's current expenses and the capital projects. Another portion may be designated for the corporation's capital reserve fund to pay for future capital projects. Well, CRA notes that the portion of the fees paid toward capital expenditures or the capital reserve fund is a contribution of capital according to CRA and is not included in income. So CRA notes that if there are any overages, money received in excess of those three, expenses, so on, that they are prepared not to have it treated as income, even though you don't meet the treaty exempt provision or the exempt portion, 149(1)L exemption, and take a look at IT 304R2. However, CRA does mention that a residential condominium corporation has to be consistent on a year-to-year basis with respect to how it treats the overages for income tax purposes. Now, active business income, we have corporations, and the question is their income active business eligible for the small business deduction? And if it is, then the shares may be eligible for the capital gain exemption. If it's not, if it's income from property, then you're taxed at the top rates with refundable dividend tax on hand, but more importantly, the shares are not eligible for the capital gain exemption. Well, we have a technical interpretation here where we have a corporation that's got a bunch of trailers which they're leasing out. But in addition to leasing out the trailers, they're making sure that they're furnished, they have dishes, they have linens, they have laundry, they provide electricity, phone, cable, even snow removal for the parking lot and the stairs, ground maintenance, provision and washed bedding, cleaning products, supply of certain products of daily use, light bulbs, toilet paper, and CRA said, you've done enough. You've provided enough services to get past specified investment business income into active business income, eligible for the small business deduction, shares eligible for the capital gain exemption, sort of like a motel versus an apartment building. Motel active business, apartment building investment business income. The next thing and the last thing I wanted to mention is this de facto control, because we have a technical interpretation where a non-resident owns less than 50% of the voting shares of the votes in a corporation, and Canadian residents own more than 50%. So you would think that would be a Canadian-controlled private corporation eligible for the small business deduction. In this particular example, eligible for the 35% scientific research and experimental development tax credit. Well, CRA was asked to comment, and CRA looked at the situation. He says, you know, you have to look at the non-resident. Just because the non-resident doesn't have more than 50% of the votes, that doesn't mean that they do not control, because control can either be de facto or it can be de jure, in other words, more than 50% of the votes. And they took a look at this one, and they noted that CRA viewed whether the non-resident had an indirect control, because if you've got indirect control, then you're controlling for purposes of not being a Canadian-controlled private corporation and all the bad things that happen. And CRA concluded that in this case, it was not a CCPC, because they said the term in the Act under Section 125, control, directly or indirectly in any manner, refers to both de jure and de facto. And in this case, the non-resident had exclusive veto rights, which indicates de facto. Also, the non-resident had economic control over the company. They had various control over the board of directors, and that was enough to say that they had indirect control, and it was not a CCPC. It was 15 pages of information that the CRA talked about with respect to that. So always keep that in mind. There's a possibility of de facto control, even though you don't have over 50% of the votes, to throw your company offside